day traders. In today's video, I will be talking about a particular strategy which you can use in trading the financial markets, which is any cryptocurrency pair that have 70 to 80% winning rates using an indicator called the stochastic oscillator or the stochastic indicator. When you use this strategy, it have 70 to 80% winning rate, and you can use it, anyone can use it to their advantage. So without further ado, let's get into what today's video is all about. So stay to the end and learn how to use this very particular strategy. It will help you in trading any financial market aside, the cryptocurrency market. Now, this is Remit Trade Academy and this is Paradise. This is the home of successful traders. If you've not registered on Binance, ensure you do so. Check in the description below and you will see my link, and you have 20% commission off when you use my link to register on Binance and also on OKX. Check the description, you will see the links. Not only that, if you've not subscribed to the channel, please do so to subscribe to the channel. We appreciate that. Thank you very much. Hit that like button and turn on the notification bell so that anytime I upload a video like this, you get notified first. What is stochastic indicator? Now, stochastic itself means having a random probability distribution or patterns that may be analyzed statistically but may not be predicted precisely. What does that mean is when you're using the stochastic, it may not predict the market precisely. That means it have errors and flaws on its own. It is very important for you to understand that there is no indicator in any financial markets, cryptocurrency market, forex market, stock, or trading options that have 100% winning rate all the time. It does not work. It does not exist. Okay, so no one should tell you there is an indicator that works 100% of the time. It's not true. All indicators have its own flaws. The same thing to stochastic, it has its own flaw as well. Okay, so but in this video, I'll be showing you a strategy that have 70 to 80% winning rate. 70 to 80% winning rate using the stochastic indicator, and I will be very precise about showing you this strategy. So watch the video till the end. So stochastic itself has its own flaw, just like any other indicator that you find in the financial space. The stochastic oscillator is a momentum indicator comparing a particular closing price of a security to the range of its price over a certain period of time. Now, the sensitivity of the oscillator to market movement is reducible by adjusting that period of time, or by taking the moving averages of the result. What does that mean? Now, the stochastic oscillator is a momentum indicator. That means that when the market moves up drastically, the oscillator moves in line with it, and it calculates it by using the closing price of the security and the range. So let's say, for example, market starts at this point and ends this at this very point. Now it will calculate the end of the closing price, that is 1 point, and the range, that is the middle value. When it calculates this, it now give you the value on your stochastic over that period of time. Okay, so it's very simple. Now you don't need to know how this value are calculated. The most important thing you have to understand is how to use the stochastic indicator very well to your advantage. And in this video, I will show you a very simple and straight strategy which you can use to better your trading and enter at a very good entry. Now, this is the stochastic indicator, and this is how it looks like. Now, I want to explain how you can use this indicator very well to your advantage. Number one, when you see the stochastic indicator, if you look at here, you see 100 here and you see 0 at this very point. Now from 0 to 20 is oversold condition. From 0 here to 20, or you can say from 20 to 0 is oversold condition. That is, at this point the market have oversell. That means when the market oversell, it means sellers are going to be tired and buyers will take control of the market. So if you see market was moving down, market was selling from here, selling all the way down. You see the oscillator enter into the oversold condition. So at this point, we see the market start going up. That is, the market start buying here. The same thing, the market goes down, it was selling. The market goes down from here on the oscillator, it was selling right down, and then at this point we see at oversold condition the market starts going up. So at oversold condition, you see what happened here, the market start buying again. So at oversold condition, you buy when you're using the stochastic indicator. At oversold, that is from 20 to 0. When these two moving averages come into the oversold condition, you buy when it's about to leave that region. That's when you're buying. When it's about to leave that region is when you're buying. These are the principles. I just want to tell you the principle behind it, and then I will tell you that very particular strategy you will use to trade the cryptocurrency market. Now, from 80 to 100, or you can say from 100 to 80 is the overbought condition. That means when the stochastic enter into this region, that is from 80 to 100, it means the market has overbuy, and what that means is sellers are going to take control of the market very soon. You can see from here, market was buying right to this point. You see from here, market was buying right to this point, and at this point we see the market now turn back down. You see the market here turn down. That is in line with this, down move. This is this impulse here. Market retrace and then go back down. You see market go down, retrace, enter into overbought condition, and then we see the market go down again into oversold condition. Now, from 80 to 100 is your overbought condition. That means anytime the market enter into overbought condition, it means that very soon the market is going to go down. That is, sellers are going to take control of the market because buyers have been buying for a very long time, and then it enter into overbought condition before the market will now go down. So you have to understand the very basis on how to use the stochastic in line with your markets, in line with your market structure. That's the most important thing you have to know. So that is how you use the stochastic oscillator. Now, the most important thing you have to understand here is it is not just about you sell at overbought and buy at oversold. It does not work that way. Now, if you just so you see when the indicator come into oversold condition, you buy, market goes up. When it comes to overbought condition, you sell, market goes down, you will lose money. Okay, it does not work like that, because if you use that and you go through the history, that is, if you backtest the chart, you discover that if you follow that particular method that other traders use in the market, you may not be successful using this stochastic. Also, that is why I have put together a strategy for you that you can use to trade the market using the stochastic, and this very strategy have 70 to 80% winning rates all the time. Okay, it's not a 100% winning indicator. Remember I said there is no indicator that works 100%, but what I'm trying to pass across is that if you say market is at overbought, you sell, oversold, you buy, overbought again, you sell, overbought, you buy. You can't win like that. That is why I'm teaching you strategy now. For you to use this very strategy, listen to me very attentively. This is what you need to do. Number one, you need to first of all identify the market structure. I talk about market structure in my other video. If you've not watched that video, check in description, you will see it, or check the channel, you will see cryptocurrency market structure, and watch that video for you to understand what market structure is all about. Because as a trader or as a professional trader, the first thing you have to do when you see your market is to define the structure of the market so that you know what buyers and sellers are doing. Very, very important. Now, when the market trend right down, when the market is going down, That's the first thing you have to identify. Market structure. If you look at this market, it is going down. Now, what do you do on the stochastic indicator? Very, very important. Now, since the market is going down, what you look out for is when the market comes to overbought. That's when you sell. Since the market is going down, look for when the market enter overbought, you sell. If the market is going up, look for when the market enter oversold, you buy. This is a strategy. I repeat myself. In the case of a downtrend, market is going down. Look for when the market enter overbought, you sell. Look for when the market enter oversold. In the case of an uptrend, you buy. So therefore, in a ranging market, you don't use the stochastic indicator for this very particular strategy. So let's say, for example, this was a downtrend. See, this market was a downtrend. Move right down. Don't worry, I'm going to go over to the Binance platform and explain in practical terms what it means using this very particular strategy. Let's say, for example, we see this market going down. Now, at this point, let's say, for example, we did not see from here down to this point. Okay. Now, at this point, if the market moved down to this point, we've not considered this to be a downtrend yet. It is still an uptrending market from the previous chart. Now, but if you look at it, market goes down, come back up, though cannot make a higher than the previous high. Now, since it can't make a higher high than the previous high, it means that there are sellers restricting it from going up. That is, there are sellers sitting here that want to push the market right down. And after a while, we see the market goes down. Now, when the market goes down, it creates a lower low, which is this low. It creates a lower low, which is the low. Lower than the previous low. This is the previous low. This is the recent low. What does that mean? Now, what that means is go on your stochastic oscillator and look at when the market enter overbought condition, and from there, so when the market goes up again, you wait for it to give you a bearish momentum candle, a bearish candle that have a little bit of momentum like this one, like this kind of candle, or you look for a certain particular candlestick pattern, maybe a bearish engulfing pattern, or bearish rami, or a pin bar, a shooting star, or all those kind of candlestick pattern before you actually trigger your trade. Okay, so what you look out for is you wait for the market to retrace. Now, when the market retraces, you're looking out for one thing. Number one, the market should not make a low equal to this low. It should make a low lower than this low, like it is. Now, we already defined that this low was lower than this very low. This recent low was lower than this very low. It means that if the market have a bearish momentum in candlestick, it means the market is going to go down. Not only that, the stochastic is already at overbought condition, which means buyers are tired of moving the market up and sellers are going to take control of the market immediately. Now, when you see that, what you look out for, you look out for the indicator to dilate from each other. That is, the red line should dilate from the blue line before the market will go up. And then, let's say, for example, in this particular trade, after the formation of this candle, this one formed, that is when you are entering your trade, and you have to place your stop loss above this very resistance level. So you are placing your stop loss at this very level to give your trade to have a room to breathe a little bit. That is, should in case the market now turn against you, we should have the first level that should hold this trade at this point, and then the second level at this point before it will hit your stop loss. Okay, so when you are setting your stop loss, ensure you give it enough room for it to breathe, so that, because most time the market will not just go down, it will go back and retest this very particular level before it now go down. So that is how you have to place this very particular trade using this very strategy in the market. Now, I want to go over to the Binance Exchange and show you in practical terms one to 3-4 example on how to use this very particular strategy very well, so that you can use it to your advantage immediately when trading. Now, this is the Binance Exchange. Let me put it on. Okay, if you look at this very market, this market was trending down. This is a downtrend market. We all know what a downtrend market is. So I search for Stochastic. Now you can see Stochastic Stochastic indicator is now on my screen. Now you can always modify your Stochastic to the number you have, but for now, as a beginner or as an advanced trader, you can also leave it at the default setting mode. Is very important. Now if you look at this very market, the first thing you do using this strategy is you have to define the structure of the market. It is in an uptrend, downtrend, or sideways market. So you define the market first. This market was in an uptrend, so we know that the market is already an uptrend. When the market moved down, go up, could not make a higher high, higher than the previous high. Then we see this was resistance, obey as resistance, market go down. See how the market go down, then it goes back up again, go down, and then now it's at this very point. Now what to do using this strategy is this. It's very simple. Since the market go down, go up. Now if you miss out on this is another area to take your short position. That is if you're trading futures and margin trading. So at this point is the first entry. This is the first entry. If you miss out on this entry, this is another second entry. Now, after defining the structure of the market, and we know that, okay, this market is going down. Now, the next thing we will have to look out for is we'll have to go to the stochastic oscillator or the indicator, and we'll look out for when the market comes from oversold to overbought. Now, when the market is trying to go down, that is when we are entering our trade. So let's say, for example, at this very point, market move from oversold to overbought. That is from this point to this point, from here down to overbought condition. Then after that, we see the market move down. Now at this point where the oscillator enter into overbought condition and then the market was going down, this is where we have to enter our trade. Okay, this is where we have to enter our trade at this very point. Now our stop loss must be placed. Our stop loss have to be placed above, not the next resistance, but before the other resistance. That is, it must be a resistance that is before the previous resistance. Very important. So you have to place your essay in such a way that the market will not quickly hit it. Now it all depends on your own very trading system and the amount of stop you will be willing to accommodate. Very important. Now, so this is where you are entering the market, and that is immediately after this candle formation, and you have to allow the candle to close first. This is what we talk about in the Remit Trade program and mentorship training. It's very important for you to allow the candle to close first before you now trigger this trade on the formation of this very candle. This way you're entering a trade. Remember, at this point, the oscillator have already entered into overbought condition and then is now selling. So you will enter this trade at the formation of this candle. That is at the close of this very one. That is the formation of this very particular candle. Very important. And once you enter the trade, see how the market ride down. Now, should in case you miss out on this very particular entry, don't worry. This one, you will not take this one. Reason being that the oscillator does not enter into overbought condition. Now, another setup that you have to look out for is this very one. This is another setup for you to enter a sell position. Now, if you look at this very well, you see the market move from oversold condition into overbought, like from here down to this very area. Now, at this point, you're looking for a candle like this to move out, and then you're looking for the oscillator to dilate from each other before you enter your trade. So you are entering this trade at the close of this very candle, because at the close of this very candle we see the oscillator have moved a little bit out of the 80% mark into this very region that is approaching the sold condition. So this is where you are placing your short position, that is your sell order. Very, very important. When you place here, we are expecting the market to move right down and even form a lower low, which is lower than this previous low. This is Ethereum USDT. So let me show you another example in the case of a buy setup. In the case of a buy setup, now if you look at this very setup, if you look at this very particular trade, if you see this market was going up, this market was going up. So if you draw your trend line in the case of a buy, if you draw a trend line and this market was moving up, this market was moving up. Now it's very simple. The strategy, first of all, you have to identify the market structure. In this case, the market was going up. Now what you do when the market is going up, you look out for when the stochastic enter into oversold condition. Enter into oversold condition, that is when you are to place your buy order. So let's say, for example, the market goes down, enter into oversold, it goes up again, we see the market form a higher high, higher than the previous high, it goes down. This is where you are to enter your trade, that is your long position. This is where you're supposed to enter a long position. So at this point, you see what happened on the oscillator. At this point, the oscillator was at oversold condition, and after then we see the market move up. So you are to enter this trade at this very point, that is after the formation of this very candle. When the candle closes on this very candlestick, then at the formation of this very candle, that's when you're entering your trade, and then you are going to place your SL, that is this very position, because at this very point, this is the recent support level that will hold the market. So you're placing your SL at this very level. Okay, then this is the point in which you have to take your trade. All you need to do is identify the market structure. Is it going down? Is it going up? And then you now use the stochastic oscillator in line with a particular candlestick pattern that you are looking out for to trigger your trade. So at this point, this is where you enter the market. Market move up, come down, you see enter into the oversold condition again. That means if you miss out on this entry, this is another point for you to enter, and then after then we see the markets move around this region before it finally break this very resistance level with the big candle break and the market move over. Now this big candle break is what we talk about mostly in the Remit Trading and Mentorship program, okay? And it is one of the thing we use to identify key supports and resistance level. Now if you've not taken our course in the mentorship program, check in the description below and contact Remit line and get into class right now, because the program will enable you to be a professional cryptocurrency trader. Very, very important. Now, so once you identify the oversold and overbought condition in line with what the market is doing, market structure, this strategy is certified. All you need to do next is identify the type of candlestick pattern you're looking out for. Is it a bearish engulfing pattern, bullish ramming? You're looking for a pin bar, a hammer, shooting star, a morning star, or an evening star. Anyhow, all you need to do is, first of all, identify the market structure in this strategy. First thing first, identify the market structure. Then the next thing is look out for when the market enter into oversold condition. In the case of an uptrend like this, you're looking for oversold condition. Oversold condition in the case of an uptrend. Now, in the case of a downtrend, you're looking for when the market enter into overbought condition for you to place your trade. These are the two most important things you have to look out for in this very particular strategy. Now, if you apply this strategy over and over again on your chart, you discover that it works 70 to 80% of the time. 70 to 80% of the time. Now, if you look at this very market, it was going down. This market go down drastically, and it come back up. When it comes back up, you see it enter into overbought condition, which means buyers are tired, and then sellers are going to take control. And we see what happened here. Market go down, come back up, cannot make a higher than this previous high, then the market go down again. These are trade opportunities for you to take advantage of. We also see a lot of it here. You see this was a typical uptrend. This was a very precise uptrend. You see here, you can draw this trend line very carefully here, and then we have, okay, I think you know how to draw a trend line. As we check the channel, you see a video that talks about how to draw trend line perfectly. Now, what you all do in this very particular analysis is, first of all, identify the market structure. After you've done that, you go on the stochastic. In this example, the market is going up. So when the market is going up, you look out for when the stochastic enter into oversold condition. When you enter into oversold condition, you wait for it to come out of the region a little bit, and you look out for a particular candlestick pattern or a slight momentum in the candlestick, as we see in this very example here. So when the market enter into oversold condition, wanting to go out at this point, then the market now trend up in line with our strategy. So this strategy work 70 to 80% of the time. So that is how you can use this very strategy to your advantage. Remember, if you've not subscribed to the channel, do so. Subscribe to the channel. And if you've not taken the Remit mentorship and training program, check in the description below and get trained now for you to be a successful professional cryptocurrency trader. We have a lot of cool stuff for you, and we will give you a course curriculum in which you are going to pass through, or the guideline of all the courses you are going to be taken in the mentorship program. It is a very interesting one. So I will see you in class. Thank you for watching the video, and I will see you in the next video.